I think one of the biggest changes in global markets over the last quarter has been just a general sentiment shift. People are willing to believe that all the problems are basically being dealt with at the moment, and that's sort of leading to, okay, maybe 2013 is going to be a better year. One of the things that's sort of reacting to that is very much the equity market at the moment. So we've actually seen some really strong returns starting to come through, certainly for December, continuing on into January. What we need to be careful of is what does that mean for the future? Australia has been able to participate very much so in that improved sentiment because the Australian market has gone up probably about 11% from the very recent low in the middle of November. And that's been an environment where the reflection of this good sentiment is actually reflected in a brighter environment for the globe going forward. And Australia participates in that because Australia is typically a high beta type marketplace, and what I mean by that is as sentiment improves, the Australian marketplace typically improves more so than other markets around the world. We very much see these conditions as an opportunity to basically set our positioning for the advanced funds very much along the lines of taking the froth off the top of the marketplace and actually looking for different strategies to be able to invest in that don't rely on the market going higher. We certainly participate in any sort of strength that the market has, but we don't actually necessarily believe that it's going to continue on in the same vein as what we've seen early on in 2013. So from that perspective, we're actually looking for the opportunities to take some profits in our funds and look for different opportunities that are still going to be able to provide the returns that we need for 2013. Even though that we've seen a very improved sentiment for the start of 2013, the key global risks are still there. The ones that were there in 2012 are still very much there in 2013. The anecdote that kicking the can down the road was really a big factor in 2012. All those characteristics are being reflected in 2013 from what we're seeing. So those risks have not gone away. Just the fact that we've been able to deal with some of those tail risk type events. Yes, some policy action has been enacted, but at the end of the day, the real problems that have caused this in the first place are still there and they haven't been dealt with. The susceptibility to some bad news at the moment can cause markets to really derail and this whole sentiment to turn around to the other side of the equation. We're very cognizant of that, and that's why we actually believe that 2013 is going to be a year where we need to manage risks more appropriately. And being able to sort of take the profits on some of our equity investments at the moment and actually invest into different strategies which can deal with these risks in a lot more appropriate manner is the best way for us to manage our portfolios going forward. Our expectation is that volatility will still be there. That volatility creates opportunities as well, and we need to be able to be flexible in order to pick up on those opportunities where we see fit. Flexibility is still going to be the key investment dynamic in any investment portfolio going forward. We need to make sure that we're going to maximise those opportunities, but also manage the downside risks more appropriately.